Listen up, we've got some good news, we've got some bad news. The good news, the market is flashing signals that we're still heading higher and you still have a great chance of making life-changing gains, building real wealth in crypto. The bad news, this opportunity will not last forever. Time is running out, so stick around if you don't want to miss the train. Let's start with the backbone of the market, the consumer. Recent data shows U.S. consumer spending rose solidly in August, proof that demand is still alive and well. But here's the catch. The University of Michigan Sentiment Index actually dipped in the latest survey. In other words, people are still spending, but they're feeling just a little less optimistic about the future. However, there is another metric that gives a more bullish perspective. One of the easiest ways to track confidence is by looking at the XLY over the XLP ratio. And no, this isn't the latest token from the guys over Ripple or something like that. It's simply a chart that compares discretionary spending to staples. Think of it like this. XLY covers the fun stuff. Your Amazon orders, your sneakers, your Netflix subscriptions. Well, XLP is the boring stuff, your toothpaste, your cereal, your toilet paper, to be used in that order approximately. When the ratio is climbing, it means people are choosing wants over needs. That signals strong confidence and a healthy risk appetite. Here's the kicker. The chart just broke above the 2021 highs. Historically, that kind of breakout has meant the market will have more room to run, and it doesn't stop at stocks. When consumers feel bold, that same risk on energy spills over, of course, into cryptocurrency assets, which are now mainstream assets. We're not in the niche anymore. We're not hiding in the shadows. Bitcoin's being shown by Larry Fink. We're in the big game now. Charles Edwards, founders of Capital Investments, one of his the first one's call this out in his words, consumer breakout. A strong consumer is the backbone of the market. Consumers typically weaken before stock markets top. We have just finally broken above the 2021 highs. That's a big deal because historically the consumer doesn't just roll over until right before the market does. It's certainly not going to be breaking out to new highs of confidence. In other words, this isn't a warning sign, it's the opposite. It tells us there's still a lot of fuel left in the tank. Maybe it's a warning sign if you're not allocated to something yet, man. You're still sitting on the sidelines. A warning, wake the fuck up, okay? But think about it. People always spend on food. They'll spend on water. They'll spend on shelter. But then when they're also splurging on shoes and streaming subscriptions and dog coins, that's confidence, baby. That confidence is a powerful tailwind for both the economy and for risk assets like stocks and crypto. By the way, if you want to trade crypto coins, you have to ask yourself, will you move over to an exchange that's actually going to respect your privacy and going to give you massive bonuses for hopping over? Well, that place is BitUnix, okay? Never been a better time to sign up. No KYC, no VPN, billable to anyone, anywhere. That's you. And here's the deal. Deep liquidity in all the big coins. Long rip, short the dips. Use the link down below. You'll get a 30% fee discount. You'll get $400 in deposit bonuses when you deposit $2,000 or more, crazy trading bonuses. And for the last couple of live streams in the month of September, you'll also be in to win our daily $1,000 giveaway. Link down below. Go check it out. It's a limited time offer, so make sure to hop on it now. Okay, so look, by now you've probably heard about the business cycle. Sheila, get the kids. He's talking about the business cycle again. You probably know the 4 phases: expansion, peak, contraction, trough. But let's today look at something else. It closely is related, but with a different lens. The credit cycle, baby. We only think of credit as a loan, but in a broader context, it's actually the economy's fuel. Macroeconomists view the credit cycle as a rhythm of credit expansion and contraction. It's all interrelated. The credit cycle, the business cycle, the global liquidity, it's all pointing one direction. We're going higher. Macroeconomists. So, credit cycle, it's a rhythm of credit expansion and contraction. Easy borrowing fuels booms with rising asset prices, while tightened credit triggers slowdowns and recessions. Loomis Sayles, a global investment management firm, states that as of July 2025, the U.S. credit cycle is in a late stage, reflecting mounting cost pressures and late cycle dynamics. Now, this aligns with Fidelity's Q3 2025 business cycle update, which describes the U.S. economy as showing a wide mix of cycle dynamics, including solid mid-cycle indicators, alongside some signs of softening activity. In other words, entering the later stages of expansion that we're now approaching into a later stage of the cycle. But macro analyst Capital Flow is challenging that traditional viewpoint. He's arguing it's not just about how much credit flows there are, but how it's structured. You know what they say, it's not the size of your credit flows, it's the motion in the ocean, baby, especially when it comes to asset liability mismatches. So let's break it down. Imagine you go long on your favorite dog coin with 10x leverage, betting a quick 5% pop will outpace your funding fees. That's a mismatch. Your asset is the gain you hope for, but your liability is the fee that keeps ticking no matter what's happening. If the market turns, you're trapped, holding a loss that keeps costing you money. Not in the leverage? Well, here's another way to picture it. So let's say you want a pair of limited edition sneakers and you think they're gonna moon in resale value. Smart, but you don't have the cash, so whip out your credit card. Your bet is that you'll flip the shoes fast enough to cover the interest and turn a profit. But if the hype dies, if the sneakers are not what they said they were gonna be, you're left with sneakers that nobody wants. Plus, debt you still owe. Now zoom out. Corporations and governments are playing the same game, except not with sneakers, but with, trillions upon trillions of dollars. Borrow cheap today, assume tomorrow's growth pays the bill. And it works until it doesn't. If markets dip or rates rise, assets shrink, but liabilities stay the same. That mismatch can turn a boom into a bust very quickly. Right now, the Fed has finally given us a rate cut. Thank you, Jerome Powell. We're sitting at 4.25%. Not exactly cheap money, but with 2 more cuts expected this year, liquidity will start flowing again. We will start seeing a thawing in things like the property market. This lowering of the rates will grease the wheels, and it means the music can keep on playing, giving markets and crypto a lot more room to run. But here's the caveat. The Fed didn't cut because everything's just so fantastic. They cut because the job market has finally cracked. It turns out there are 911,000 fewer jobs than previously reported. That's not noise. That's the economy quietly slowing down. That was Biden's economy, okay, to be fair, but still a big revision. So the big question is, did the Fed just save the party? Or are we watching the collapse now play out in slow motion? Now, for now, GDP might be the saving grace. The U.S. economy grew at 3.8% annual rate in Q2. The Atlanta Fed's GDP Now model is projecting 3.9%, potentially even 4% for Q3, which is America's running hot, baby. Strong growth plus easier money is a rare combo. And for risk assets, it could be rocket fuel, which is a good reason to celebrate. However, you might want to delay popping this champagne a little bit, at least until you've taken some damn profit on something. Anyway, because time, of course, is never really on our side. The end of a credit cycle is not pretty. Take the 2008 global financial crisis. It was a raging party before that one finally popped. According to a 2018 St. Louis Fed report, total debt rose rapidly in the years preceding the Great Recession, peaking at 370% of GDP shortly after the fall of Lehman. Now, this ratio has since stabilized at around 330% of GDP, a value that is still very high by pre-2008 standards, and high leverage in the financial system is, of course, partly to blame for the crisis. Now, this is one of the nastiest recessions in modern history. It was an epic crash. And this, of course, partly due to easy borrowing. The boom-bust patterns continue because that's what modern central banks have given us, okay? But these busts have the same pattern. Credit climbs too far, leverage builds, mismatches grow, and then the unwind hits hard. One of the last strong pillars before a top is, of course, a confident consumer. Once consumers tense up, the collapse usually follows. However, I still believe we've got at least one leg left up in this market, fueled by rate cuts, AI tailwinds, and strong GDP momentum. In fact, the market may not have a final peak until well into 2026 at some point. 2027, if some ancient astronaut theorists are correct. Make no mistake, just one misstep, a black swan event, a surprise tariff, or a geopolitical shock like NATO being dragged into a shooting war with Russia could absolutely flip the script overnight and send markets in an absolute tailspin. Crypto specifically, the real curveball might not even be regulation, but simply an over-leveraged treasury company that suddenly can't refinance its debts. And I think a lot of these treasury companies won't survive the next bear market. That'll add a lot of pressure. And when we see some big capitulations near the bottom of the bear market, that'll probably mark the bottom of the bear market. That kind of shock, though, when it happens, when we start seeing some of these things unwind, will be a major trigger for the entire space. Now, nobody can predict what exact trigger is going to send us into the next bear market. But what I do believe is that the window runs into Q4 and probably into mid-2026 for a final peak. That's the cash out runway. We have 6 to 9 months, perhaps, of really crazy, exuberant, stupid shit happening. Okay, that's your cash out runway. Now, I'm optimistic. There are still a lot of opportunities ahead, but optimism doesn't mean complacency. I'm always ready to press the sell button if things go south and if I'm wrong, to preserve capital, because in markets, the only thing worse than missing the top is riding the whole way back down. Don't let that be you. Anytime you're looking at your portfolio and you see you have life-changing money, consider changing your life. Consider the implications of changing your life for your wife, your parents, your family, your kids, what that can do for you. There will always be more opportunities in the markets. You need to remember that. And if we run for as long as we think we could run, then there's going to be a lot of opportunities. But opportunities don't last forever. And if you're sidelined, or if you've been afraid to get on new opportunities, examine that within yourself and figure out what the hell you're doing wrong, okay? Don't be exit liquidity at the top. It's not fun. Thanks for watching.